All righty, folks. If you watched our first discussion with Mr. Dan Bird from Breakpoint Trading, we tried to use a new technology, StreamYard, but frankly, it wasn't as clean for all the things that we want to do for you. So we will no longer be using StreamYard for Dan Bird's discussion. We will go back to using Zoom. We tried, but Zoom from now on. How you doing, Dan?
Good. It was good for a one-on-one conversation and for viewing a static screen.
Correct.
Or just one screen. But if I want to share multiple things, then it didn't seem to work as well.
Yeah, and then if you add in additional technologies like highlighting your cursor, and it just wasn't there for us. And to be fair to StreamYard, it could absolutely be user error. But you know what? I've got Zoom for a reason. We will just do Dan Bird with Zoom, and that is okay. Sure. And conversation number 2, Dan, earlier this week, I think it was Tuesday, it might have even been Monday, I put out the idea that for the first time, I have to consider a no landing scenario. I don't know if you've checked GDP now, but it's currently showing 3.4% call for Q3, which is pretty interesting. And the reason I think it's important is I think a lot of people were starting to set themselves up for lower rates, right? Obviously, I'm a real estate guy. I was seeing so many people after the Fed cut calling for rates to be in the mid to low 5s, and even some brave souls saying in the 4s. Well, that didn't happen. And I think if we have a no landing, rates could be appreciably higher all year. I'm talking above 6.2. They could be 6.2 to 6.8 all year. And I think a lot of people were counting on something in the 5s. And the reason this
does that imply higher inflation too?
Well, I think when I look at the dominoes, when I think no landing, the first thing I think of is higher for longer. Certainly the 10-year stays above 4. The problem is we have too much debt. One of the things about a recession, soft, hard, whatever you want to call it, is it's a cleansing. It's a cleansing. We purge bad debt. We purge bad deals. And my fear is if we go higher for longer, we're not going to have that. It'll just be a lot slower. We won't have this full on purge. It'll be onesie twosies, and they'll be very painful for the people involved. But I never thought I'd have to think about a no landing scenario.
So that changes scenarios for lots of different things.
Oh, absolutely.
Higher, and when you're talking about purging debt, you're talking about corporate debt, individual debt.
Yeah, absolutely. So again, if you're higher for longer, your corporate bankruptcies will go up. Again, it won't be a big wave. It won't be like 30 companies in a weekend. It'll be here's one, right. Here's one. And personal bankruptcies will go through the roof. And then the last thing when I play on this is the other thing I think will happen is the unemployment. The unemployment rate will go up, but I don't think it goes up crazy. But what does go up is length of unemployment. Because if the environment is slowly working through a debt cycle, you're not going to be hiring a lot of people. So I think if you are unfortunate enough to be laid off or purged or acquisition or whatever, I think you're going to be on unemployment for months or quarters. That's my big fear, because that could really start a doom loop for many families if they're not ready for it.
Not only that, but it then feeds over into government debt.
Correct.
I mean, you're talking about private debt, but that would feed over into government debt as well.
Oh, for sure. Government's debt's being refinanced, every week. They're doing 5s and 10s. Yeah, if the 10-year note is appreciably higher, that's going to just add to the interest. I think we're already paying like $1 trillion a month or something stupid. So it's pretty wild.
Actually, let me share my screen and we'll take a look.
Okay.
We'll see what we actually are paying. Can you see that?
I can.
So right here on the front page, I have debt per citizen, 105,000. Debt per taxpayer, 271,000. And total debt to GDP is 137%.
Yep.
And I have a link right here to the debt clock, so you can actually see the debt as it's going up. So 35 trillion in debt right now.
Yeah.
This is the debt to GDP, 122%. And that actually went down a little bit. No, it's over here. There's the one I used. Total debt to GDP ratio, 135% over here. Right. Oops. Oh, I didn't know it could do that.
There you go. That's all right. So
yeah, I mean, on something.
There you go. So again, I think this whole no landing thing, I think naturally when people think no landing, it's like, great, booming economy. No, not necessarily. Right? It'll be booming for, a portion of the economy. But I think there will be.
So that brings back the conversation about stagflation again.
Absolutely does. Right? Yeah, I think the economy would be like stuck in a mud. That's exactly the analogy. It's like it'll be a big yuck.
So we talked about CPI in the last video, but the next one is not going to look good, I don't think. I think it might actually start ticking higher.
Yeah, I think we talked about that, and in the net that out is unemployment's going to go up and inflation could go up, and that'll be an interesting combination for the Fed to talk about.
That's a double whammy for the Fed. So what do? Do they continue lowering to help unemployment, or do they start raising to reduce inflation, or they just do nothing?
Again, I think it's been very clear, and again, this could all change at a moment's notice. But if unemployment, they're most concerned about unemployment, right? Yeah. For the longest time, they were single mandate driven, meaning get inflation down from 9. I think most of them are declaring victory at this point, and they are every speech is employment. So I think if unemployment goes from 4.1 back to 4.3, or heaven forbid 4.4, cuts are coming.
Yeah, 4.4 is their target. I mean, they've said that's where their expectation is that it's going to go to 4.4. The question is the acceleration, because when the unemployment rate starts to accelerate higher, it goes very quickly.
Yeah, it's an elevator, not stairs. Yep.
Right. So if it goes from 4.1, which is that now, to 4.3 on November 1st, then that's an indication that it may be heading higher very quickly.
Correct.
And that's what they don't want. So that could cause them to go half a point.
Yeah, then again, folks, you got to pay attention to this. November 1st is a big day. It'll be the jobs number. It is a couple of days before the election, obviously, but also a couple of days before the Fed meeting the following Wednesday. So it could move the market.
We've talked about, and actually had a comment from a subscriber when he read my newsletter. He said, "I'm surprised you didn't say anything about the last week of October being historically one of the worst weeks, and that's usually where the market bottoms, and then it starts to take off for the rest of the year." And this time it's kind of reversed. Last year, the market from July until October was going down. This year, it's been going up. We've had a lot of positive catalysts, which I've talked about the last couple of months, but both with the unemployment rate going down and CPI going down and the Fed cutting. So there's been lots of positive catalysts at this time of year.
Yep.
We could start to get some negative catalysts.
We could.
Unemployment rate going back up, CPI going back up. The Fed, I think, still going to cut in November. And I think it'll be a quarter. But those other two things it's going to cause a lot of uncertainty. And then you've got the election right in the middle of that, which is also going to cause uncertainty. And that's what I heard a lot at the Money Show, is this whole idea of uncertainty, and everyone can't believe that they don't trust the bull market. One guy even said that. He goes, when is this going to stop? It just can't keep going up. And I said to him, well, why not? Why can't it? I mean, give me a reason why it can't keep going up. And he couldn't really think of one. He goes, because it doesn't do that all the time. No, that's true, but that's not really a reason. It can keep going up. The market can stay irrational longer than you can stay solvent.
Absolutely. I think it's a Buffett or Munger saying. Yeah, absolutely.
So let me, you took off my sharing, but let me share again.
Yeah, please. I just didn't want to look at that debt clop. All those numbers were making my eyes go crazy.
Kind of depressing, isn't it?
Yeah, exactly.
This is actually from my newsletter this week, and I get this from Real Investment Advice. They put out a free newsletter every week, and I include some of it. Here's a link to their newsletter right there in mine. I put some excerpts in, but this way they talked about earnings, that earnings are still strong and remain optimistic. Earnings revisions right now are the most negative. So revisions means they're revising lower, right? It's the most negative since December of 22. But here's the interesting chart. This one's kind of interesting. Non-financial economic profits, a percentage of GDP, it's at all-time highs. It's usually at about 15%.
Wow.
Of GDP. It's all the way up at 17% now. But this is the one I wanted to show you. This is the greed fear index. And I actually had a subscriber say, that's a really interesting one. Is there any way you can duplicate that, put it on your website? And I did a little bit of research. I don't know if Stock Charts has something like this, but I'm going to check it out. But the greed fear index is something that was put together by CNN of all people. And they use multiple different indicators. So you can see them up here. It's put call ratio, the VIX, bullish percent index, which I've got all of those on various charts, but they kind of combine them all into what they call the greed fear index. And the comment, and this basically encapsulates the comments that I heard this week at the Money Show. Composite allocation fear greed index, while not yet at extremes, is beginning to reach levels more associated with market peaks than bottoms. That is the comment that I heard more than anything else at the Money Show. We are not at an extreme. We are not overbought, but we're getting close. And everyone kept saying that. We're not there yet, but we're close.
Yeah.
So, caution is advised, of course.
It's
but
funny.
The market can keep going up.
One of the things I wanted to ask you, and again, I don't know if you could see it in the data, and if you don't have it, maybe we talk about it next Sunday. One of the things, and this is basically me just watching Bitcoin casually, and I think it does have ramifications for the bigger market that maybe you can point at, is I think the last 10 days or so, at least Bitcoin and crypto has started to anticipate a Trump win. And I think what's happening in the Bitcoin or crypto world is there's been a rotation to that. I think the market's betting that there will be a Trump win. I'm not saying that's good or bad. I'm just saying that's what Bitcoin is doing. I don't know if that's true. It just seems like that from the data I'm collecting. I don't know if there's stocks that are better pro-Trump versus Kamala, but it'll be interesting to see how stocks are like, are stocks rotating and calling it out, or maybe they're not. Maybe it's just wishful thinking.
Yeah. Why do you think Bitcoin would be better in a Trump administration?
Just based on the articles that I've read, again, maybe she's changed her position. But again, based on the readings that I've seen, he's been saying Bitcoin and based on that. And I think she was at least historically negative, but again, I think she may have changed her opinion here recently. I don't know.
Yeah. Not surprising.
Just based on the people that I follow in the Bitcoin world,
right.
It seems like they believe, and again, they could be wrong, that crypto will be better off under Trump than Kamala. And I'm not saying that's good or bad. I'm just saying I think Bitcoin's behaving that way.
Right. So purely from a technical perspective, Bitcoin has been consolidating. It's actually been kind of this is a 3-year chart, by the way. So these are weekly bars.
Okay.
So it's been in, for most of this year, been in a downtrend.
But could you just show me the last 90 days?
Sure.
Because that's where the change would be. It would have been in the last.
You can kind of see it right through here, all of these green bars right there.
Yeah, I think it's more pronounced.
Before I show you that, you can see the resistance. That's the all-time high right there. So it's starting to move back up to the all-time high, and the momentum indicator is starting to cross over. The longer-term momentum is crossing up. So everything is pointing to a continuation higher. But if we look at let's look at the last 4 months.
Yeah.
And let's do it on a daily chart. All right, so there's 4 months. So again, the resistance is up here.
Yeah.
It's not screaming higher, but yes, it is definitely going higher. It's now above all of its moving average lines, including the 200.
Okay.
So everything, it's The momentum is still going higher, but might be starting to roll over. So it's kind of flattening out right here the last few days.
Well, I guess it is there, right? Because in early September, it was kind of in the low 50s
Yeah.
or maybe mid 50s, and now it's, knocking on the door of 70. That's a
Yeah.
30% move,
Yeah.
roughly.
It's a big move. Bitcoin, you gotta remember the big numbers that Bitcoin commands.
Yeah. Yeah, true.
It may not be apparent just by looking at the chart, but that's a pretty big move. Even if you had just one Bitcoin,
Yeah.
that's $20,000 you made in a month
Yeah.
and a half, right?
Yep. Okay.
So yeah, but I don't
I
know if a Trump win is going to be better for Bitcoin or not.
No, I don't. But I guess the bigger question was, I've been following this because I have one. I have a little bit more than one.
Hmm.
Um, but the bigger question for you was, and maybe it's a next week conversation. Are there stocks, or maybe it's not stocks, maybe it's sectors that are better under one or the other? I have no idea. I haven't thought about it. It's not. I don't play in the stock market, so I don't know.
Yeah, we could talk about that next week. I actually read a couple of articles that talk about that. Here's the
Okay.
stocks to own if Kamala wins. Here's the stocks to own
Yeah.
if Trump wins.
Yeah. And
And
again,
I
it'll be
actually,
non-judgmental. It'll just be these are what we've.
that's right. Yeah, and I think I created a watch list. I'm not prepared to go search for it right now, but next week we
Next
could
week.
talk about
Yeah,
it.
next week's fine. 'Cause
The
we'll
other
be
thing I
1 week
wanted
out.
to talk about regarding the debt is this slide right here. 5 facts on interest payments on the federal debt.
Hmm.
And pay attention to the dates. So interest payments on the debt total 476 billion in 22, 23. Interest rate on the debt was 2.84. That's higher now.
Of
Oops.
course.
Right. So this is going to continue to go, well, from this date, it will go up, but may start to come back down.
Mhm.
Interest payments are expected to reach record high levels in relation to the size of the economy by 2029.
Oh, that's frightening.
2029. FY 2031, the federal government will spend more on interest than on combined non-defense discretionary spending.
Hmm.
And higher interest payments on the debt hamper economic growth.
Well, haven't you been telling me that 2029 to 2031 is kind of like
Yes,
wake up?
that's exactly why I wanted you to focus on those dates.
Oh,
That's what, some people think that the debt is going to crush us next year.
no.
It takes longer than that for the debt to really have a major impact.
So I just want to play crystal ball. Let's assume all of this happens as planned. And what is 28? 28's like 4 years from now.
Mm-hmm.
I mean, what do you do to prepare for this? Do you go into this going, hey, let me take half my chips off the table. Let me sell, half my stuff and just see what happens. What do you do if you really, really believe 2031 is going to be nasty?
Well, the first thing is you don't just assume that it's going to be nasty. You don't,
Right. You don't anticipate.
you don't have a gut feeling about it and take all your chips off the table. You wait for the data to tell you.
Right.
That's what technical analysis is all about. It's not about predicting what's going to happen.
Yep.
It's about risk management.
Got it.
So right on my front page, I've got that 2029 date right here.
Yep.
This is the secular bull and secular bear markets. And now you can see that we are well above the trend line for this secular bull right now.
Mm-hmm.
But the momentum indicators are not. They still have room to go higher. Even though this one is over 70, it's up in the area where these were.
Mm-hmm.
It's only just got there. This is a monthly chart. So this takes a long time for this to move. So these are months. Each one of these bars down here is 1 month. Okay.
Got it.
So if you look at this, and this goes back 100 years, secular bulls last roughly 18 to 20 years. Secular bears are about 12 years. You get cyclical markets inside of them. So we had a cyclical bear in 22, but it never broke below the 200-week moving average right here, including COVID. Even though it went below it, it didn't close below it. But all of this has stayed above. So this has stayed in a secular bull market. And all of these indicators up here, even though there's 1, 2, 3, 4 times it came very close to going below this line down here, that would put it into the secular bear category. It never did. It reversed and went back. Even during COVID, it didn't go below it.
Right.
So this is the thing to watch.
Okay.
Watch this. And when this starts to roll over and, when it starts coming down like it did right here in 22, you have to start being concerned and think about it and maybe start taking some chips off the table. But you don't do it just because you have a gut feeling that the debt is too big and it's going to crush us next year.
Right.
It will crush us eventually, but it takes that is a component that takes long time for that to happen.
Right. I agree.
And it could vary, just like that slide, 2029 to 2031, somewhere in that range. That's when the secular bull should end. We should get another secular bear, which means a big sell-off. And we'll get a rally, but it won't go above the previous one. So you've got 12 years where if you bought over here and waited 12 years, you would have made no money.
Got it.
That's what a secular bear is all about.
Yep.
So that's the thing to do. And the other thing that you do is you start understanding how to short. And right here on my website, I put inverse ETFs. So when all of those things start to happen and it starts to roll over, you don't have to actually go short. Going short means you borrow shares,
right,
because you think it's going down, and your risk is unlimited, right? Because it could go up forever.
Right.
So if it starts going up and you're short, there's no limit to how much you could lose. But this strategy is not shorting. This doesn't mean you borrow shares. This just means you buy inverse ETFs. So like on the NASDAQ right here, QID is the 2 times. So if the NASDAQ goes down 10%, this will go up 20%. And these charts actually show you. So you've got the long side on the bottom and the short side on the top. Right now, it's not the time to start buying these. But when those things start to roll over, when all of the other data and indicators, and you and I will talk about this as that starts to happen.
For sure.
Because I'm tracking the data all the time. So on our show, people that tune in on Sundays, we will start talking well in advance of that happening. And we're just not there yet. Right. So if you understand these, and this is just like buying a stock, so it's not that difficult. You just buy an inverse ETF when the market starts to tank, when we get into that secular bear market, and you make money when the market's going down. So that's the things to do.
Awesome.
The other last thing I'll talk about on my website is I put, and I'm going to start doing this every week, put a chart of the week on here. And this is the chart of my chart of the week for this week. It's the NASDAQ. And this is because of, at the money show, everyone was concerned. They were saying, it has to roll over. The market has to go down. It's been going up for too long. Well, here's the chart of the NASDAQ. This is a weekly chart. There is nothing on here that indicates it's ready to go down. It's going up. Whenever it has pulled back, it's never pulled back, below the green area. It's never pulled back below the support area. The relative strength has stayed up there above 50%. And the longer term momentum indicators are still up there as well. And you can see right back here, that was the signal that it changed from short to long.
Right.
That was all the way back in March of 23. And if you had just stayed with these all the way through, even though you had to, weather some of these pullbacks, it never actually broke any of these lines. Right. And there's no indication it's going to now either. It could just keep going higher. So again, look at the data. Don't use gut feel. Don't go by what people are saying. Don't listen to Kramer. Look at the data. See what the data is actually doing. What is the market actually doing? Technical analysis is a visual representation of market psychology. So this is all you need to know. This is price. At the end of the day, price is king. Price tells you what the market's going to do. This just tells you what the psychology of the market looks like.
Love it. Well, I love the fact that we talk every Sunday. I love the fact that you have breakpointtrading.net. You've got a weekly newsletter that is must read. Where can people follow you?
Yeah, so here's the website. The newsletter is in the upper right. So you just go to this link right here and click on the newsletter, and it'll let you download it. There's some cartoons in the beginning. Here's recession. So maybe we won't have a recession, but the recession, they're already cutting up the bull.
Got it.
here, this epitomizes most of the people I talked to at the money show.
Yeah. Now what?
This is what they were thinking. Are we at a peak? So now what happens? Both the bulls and the bears. Now what do we do? Yeah, here's everybody's in the unemployment line, but their 401k is doing great. So yeah, so that's my newsletter. I put it out every Saturday.
Very, very cool, man. Well, I look forward to this. Thank you for doing this again, folks. We tried to use StreamYard. We will not use StreamYard. We will keep using Zoom for our Dan Bird discussions. You're amazing. Thanks for trying.
All right. Have a great weekend.